As we approach the end of 2017, let's take stock of the Country Risk Quarterly's country risk rating changes over the last 12 months. First, a refresher. The CRQ covers 100 countries, with each country being assigned 3 risk ratings measuring different types of country risk. In a global environment that is never short of a country-agitating headline, our country risk ratings have moved in tandem. Throughout 2017, our analysis indicates that EDC country risk ratings experienced a balanced number of rating upgrades and downgrades, driven by risks ranging from economic, political, and financial. Let's break down some of the risk trends that piqued our interest. Starting with the Americas, most of the rating movements were to the downside. 5 downgrades to the sovereign's probability of default and 9 to our transfer and conversion of foreign currency risks. What led to these changes? Following a string of severe weather conditions, small Caribbean islands like Antigua and Barbuda and St. Martin were downgraded due to the limited government capacity to manage significant risks to physical infrastructure and economic activity. Additionally, the country continues to be weighed down by soft commodity prices, causing a consistent drag on economic activity and investment in natural resource-dependent countries such as Bolivia and Trinidad and Tobago. Pressure on government finances and access to foreign currency remain the main risks in the region, particularly those with limited sector diversification. Moving over to Europe, where country risk shifts in 2017 paint a rosier picture. Several Western European countries have been reaping the benefits of a euro area recovery, leading to sovereign rating upgrades for Croatia, Bulgaria, and Cyprus. Cyprus is experiencing the green shoots predominantly from a domestic financial recovery, while Croatia and Bulgaria move in tandem with the economic recovery of the euro area. Regionally, improvements in government finances and a stronger business climate will lead to a more stable outlook for most of the countries in the region. Heading to the Middle East and Africa, we see several countries experiencing varying levels of turmoil. Weak commodity prices, shaky political environments, and intra-regional tensions bleed into higher political violence and economic risks throughout the region. Algeria, Tunisia, and the Republic of Congo have felt the squeeze of lower oil prices and public discontent, leading to downgrades to their sovereign probability of default ratings. EDC's Global Economic Outlook expects crude oil prices to remain subdued, hovering around $55 a barrel over the next few years, causing further shrinkage of public and export revenues. Government's ability to manage through the price downturn, attract financial flows, as well as maintain social stability will determine which countries will be able to maintain or improve their country risk ratings moving forward. Debt sustainability risks in the region will also remain top of mind as global interest rates and financial flows normalize in conjunction with a U.S. and Eurozone consistent recovery. One bright spot in 2017 was Ghana, which saw most of its risk ratings improve. Finally, Asia. Political risks lead rating trends in the region. An ongoing Islamic insurgency and the government's crackdown on the drug trade, which highlights some underlying risk factors, have led to a deterioration in the Philippines country's political violence rating. On the upside, Indonesia saw a reduction of political violence and expropriation and government interference risks, driven by improved governance and political stability, as well as a greater openness to foreign investment, slowly leading to an ameliorated business climate. The bottom line, 2017 was a year of many ups and downs. Weak commodity prices, political tensions, and fundamental financial fragility balanced against recoveries in the world's largest economies and structural improvements in those reaping the benefits of an increasingly globalized world. As we look forward to 2018, we know that volatility is here to stay. But on the other hand, it looks as if recovery is as well, along with some countries' better ability to withstand the storm. I'm Andrea Gardella. Peter Hall will be back next week.